The dividend king Hormel Foods looks to be severely undervalued, with institutions buying a significant amount of shares of this beaten down company. It is down 30% year to date, right there towards the 52-week low, with a forward yield of 3.44%. But is this a buy now? And in today's episode, we are going to run through a lot of information to find out. We're going to do a lot of research. We're going to look at the historical performance of Hormel Foods Corporation. We're going to take a deep dive into their income statement, their growth, top line revenue, bottom line net income year on year. We're going to take a look at the balance sheet, take a quick health check of the total cash versus total debt. We're going to look at the performance of Hormel Foods versus its close competitors' total return year to date and over the last 5 years. And we're going to take a look and see what exactly are institutions doing with this company. This is going to lead us into that all-important dividend safety, some very interesting financial metrics and dividend metrics you need to understand before investing in Hormel Foods. And as always, we will run it through our stock valuation model, getting to our intrinsic value and our acceptable buy price given that investor margin of safety. Now, Hormel Foods has been absolutely battered, down 30% year to date, right there as mentioned at the 52-week low. Now, with a forward yield of 3.44%, we want to understand, is this a very cheap price whereby we can expect both share price appreciation, 2, 3, triple even the current share price, as well as seeing our yield on cost in double digits? Well, investors who have been holding the company over the last 10 years would have seen around 49% on their return on investment. Not the worst, but really not the best. We want to be aiming for at least 100% or more, but also bear in mind this doesn't include those dividends reinvested. Now, the market cap is fairly small, around 17.5 billion, so let's take a deep dive into this company. Now, income statement, what do we like to see? Personally, 3 to 7% growth on the top line year on year. October 2018, 9.5 billion of revenue reported. 5 years later, their latest annual report, 12.5 billion. So some nice growth over the period over the last 5 years. On a more granular level, what we can see from 2018 to essentially 2020, the top line did remain relatively flat before increasing in 2021 to 2022 as well. So slight inconsistencies. It isn't revenue growth year on year with this company, and we will shortly look at the 10-year growth as well as percentage-wise. Bottom line, how has it fared? Net income, well, 1 billion of net income in 2018. Latest annual report, their bottom line again around 1 billion. So relatively flat on the bottom line, even when you consider the top line growth from 9.5 billion to 12.5 billion. They haven't managed to increase that bottom line net income. And on a more granular level, we can see again relatively flat from 2018. In fact, relatively flat throughout the last 5 years. So do bear that in mind, and we will talk about that shortly as well. Now, in terms of the balance sheet review, total cash versus total debt, total cash and short-term investments, 460 million in 2018. Latest quarterly report from a few weeks ago, 687 million. So they have got a larger portion of cash sitting on their balance sheet than they did 5 years ago, but not a massive amount more. Now, directionally and numerically, how does the total debt compare? Well, when we take a look, we can see 625 million in 2018, not a significant amount. And in their latest quarterly report, around 3.3 billion. Now, that is quite a large increase from 2018, but again, it isn't the most biggest if we look at that in terms of actual value, and we will again look at the metrics that support that to see whether or not this company can pay their debt. Now, in terms of some close competitors of Hormel Foods in the similar industry, the packaged food and meats, we have Kellanova K, Tyson Foods, Associated British Foods, McCormick and Kerry Group, a few which you may have heard of already. Now, total return year to date, how has Hormel Foods compared? Well, what we can see, in fact, the industry as a whole has been hit very, very poorly, and we can see it's around 28% year to date down. Not the greatest, in fact, from what you want from any investment, but year to date, other than those big technology companies, the market as a whole hasn't performed that well. Now, over the last 5 years, again, Hormel Foods, including total return, reinvesting those dividends, down 11%. Not the greatest at all, and interestingly, we can see every single one of their competitors are also down negative return. So what we want to understand, whilst knowing that previous or past performance doesn't indicate futures, is now a great time to buy this company to get some significant gains, both on the share price and yield on cost over the next few years and beyond. Now, institutions own around 41%, and what's very, very interesting to see, over the last 12 months, 648 million have been sold shares by institutions, but 6.53 billion have been bought. Institutions are really liking the current price of Hormel Foods, and we can see Q2 of 2023, 5.51 billion shares were bought as opposed to 209 million sold. So a lot of interest by institutions, and we'll finally sort out later whether or not this is what we believe to be a buy right now. Now, dividend safety score 99, making it very safe. In fact, the safest score one company could have. Market cap around 17.5 billion, making it a large cap company. Now, for those who believe we're heading into a recession, well, how did they perform in the last recession? In fact, they increased the dividend during 07-09 recession sales. Whilst it was negative, around negative 3.7%, this was above the average growth of companies during the 07-09 recession. And what we can see here, recession return negative 15%, and whilst that is a poor in any investment for a negative return, it beat the S&P negative 55% from the same period. So a few things to just digest there, but fairly positive if you believe a recession is coming. Dividend growth, 5.8% increase, the latest one November 2022, which signals to me we are expecting an increase from them over the next few weeks. 9% compounded annual growth over the last 5 years and 13% over the last 20 years. Now, one thing to note that's very important here, they have been increasing those dividends for more than 50 years, in fact 57 years, making them a dividend king. And what I love about all of these percentages for dividend growth, they are above 4%, which is what I say for your salary, dividends and other income producing assets to get at least a minimum of 4%, as the US inflation rate over the last 40 years was 4%. Anything less, you are in fact losing your purchasing power and taking a pay cut. Now, dividend yield theory states a company is undervalued when the current yield sits above the 5-year average. 3.44 versus 2.08 are first sign of undervaluation, but bear in mind we never look at any of these models in isolation, and we'll draw a conclusion towards the end of the episode. Forward PE 19 versus 24.4, again another sign of undervaluation, and we can see here the sector PE roughly in line with that of Hormel's at 18.2. Now, bear in mind at the beginning of the episode I did say it is towards the 52-week low, but bear in mind 52-week low does not signal undervaluation. Likewise, 52-week high does not signal overvaluation. Earnings versus free cash flow. Now, regular investors and subscribers to the channel know we don't look at earnings. It is susceptible to manipulation by management through accounting, and there are some videos where I have gone through to explain exactly why. So free cash flow is what I personally look at. Around 60% and below is the sweet spot in my personal opinion, so management have the ability to increase those dividends to double digits that we love to see. Hormel Foods over the large part, in fact, has been below 70%, again not the worst, and we can see the last few years in the high 60s. 2023, interestingly, is expected to come down to 54%, which is a positive in my opinion, so I would like to see around a minimum of 8 to 9% in the increase that's coming over the next few weeks. So far, positive to see for Hormel Foods. Earnings per share, again, the information is there for investors that like to look at that, but I will focus the attention on the free cash flow. $1 in 2013, $1.57 in 2022, with 2023 expected to be $2. Now, it isn't the fastest growing company. The free cash flow isn't increasing year on year consistently either, but it is going in the right direction. But again, bear in mind, it is a slightly inconsistent company. Now, as I mentioned, sales growth, what I like to see 3 to 7% year on year. In actual fact, some years they have done that, a few years where it's been double digits or above that, but again, some years where we see negative growth. So again, inconsistency seems to be the theme with this company so far. Numerically speaking, around 9 billion of sales in 2013 and 13 billion in 2022, an increase of around 50 or 40 to 50%. But again, we can see for a large period, it was relatively flat. So again, this is one of those companies that isn't increasing year on year massively. Shares outstanding, very, very little to talk about here. Whilst we love it when companies do share buybacks to return excess cash to our pockets, we can see for the large part it has remained relatively flat, with a few million here or there where they have in fact issued shares and diluted shareholder ownership, but again, very minimal. Now, ROIC, one of my 7 golden dividend metrics. If you want to see the other 6, do check the pinned YouTube video. 10% plus is what I like to see. It means management are able to effectively allocate that capital. For the large part, it has been 10% and above, but we can see, in fact, 2013 to 2017, it was in the 20s, which is very, very strong to see. Slight worry that it is downward trending, but I would like to see a minimum in 2023 of at least 10%. Otherwise, there could be some issues to see. Now, this industry finds it very difficult with their operating margins to be as high as we like to see, but 16% is the ideal threshold that I would like to see for a company. Now, it has been, in fact, well below that year on year consistently, and in fact, it has been decreasing. 2023, I would like this to see go up to 12-13% with the overall aim to be around 16 over the next 3 to 5 years. Free cash flow margin, however, consistently around that 7% mark. So there are some positives with this company, also some things just to bear in mind. Now, a beautiful thing about this company is their debt level. So the net debt to earnings before interest, tax, depreciation, amortization is the metric we look at to see how many years it would take the company to pay off all their debt net of cash on hand. Whilst 4 is the maximum we look for companies in the consumer staples industry, over the last 10 years, it has been well below that. 2022 at 1.15, 2023 at 1.31. So I have no worries about this company and that all-important dividend safety score. As we can see here, net debt to capital purely showing us the percentage of a company's financing from debt as opposed to equity. As always, if you do enjoy the content, value is being provided, smash that like button, hit the subscribe and bell button so you'll continue notified of these videos which drop regularly to your doorstep. And as always, if you want to grab a copy of the model to run your own companies through to get your own intrinsic value and acceptable buy price, then do click on the pinned comment below. Now, the first model we're using for Hormel Foods is the Graham's valuation. We have the stock ticker, growth rate per analyst estimates at 12, and that yield on AAA corporate bonds at 5.4, giving us an intrinsic value of $25. Now, we can see that is significantly lower than the current trading price, well below the 52-week price range, showing signs of overvaluation in the current market. But bear in mind, we never look at any of these models in isolation, and we'll draw our conclusions towards the end of the episode. We then have the multiples valuation model, companies we looked at when we were looking at the comparison for total return over the last 5 years. Kellanova, Tyson Foods, McCormick and Kerry Group. Stock price, earnings per share, PE multiples, average PE multiplied by the earnings per share to give a Hormel Foods multiples valuation price of $45. Now, this shows us some nice upside to the current trading price, slightly lower than the 52-week high seen not too long ago, and showing signs of undervaluation in the current market. Thirdly, the dividend discount model, we have the yearly dividends as we can see, average growth rate around 8%. We can see the high double digits over the last few years, however, they have come down to the single digits. Forward looking, I've gone for around 5.5%, slightly lower than the last year increase. But again, if you do believe you can justify a higher or lower percent, do go ahead and grab a copy of the model to see what your figures would come out with. This gives a DDM price of $46. And again, upside to the current trading price, undervaluation in the current market, but slightly lower than the 52-week high. We then move on to the fourth and final model, the DCF model with the free cash flows year on year. Average growth rate around 6.6% with analysts estimating 8% forward looking. We can see with that discount rate, we get the present value of future free cash flows and terminal value. Add that together with the cash, subtract total debt, and we arrive at the equity value. Divide that by the shares outstanding, we get a DCF price of $39. Again, upside to the current trading price, signs of undervaluation in the current market, but lower than the 52-week high. This now gives us the intrinsic value, which is the average of the 4 models we have just run through. And as always, if you do enjoy the content, value is being provided, smash the like button, hit the subscribe button. It helps the channel tremendously, and I love the support from the community. The intrinsic value is essentially the average, which comes to $39. Again, as we can see, upside to the current trading price, but lower than the 52-week high. And don't forget, if you want to grab a copy of the model, so you can run your own essential figures through or companies in your portfolio to get to your intrinsic value, do go ahead and click on the pinned comment below. So the margin of safety, as I always mention, 10% is what I'd use if I believe it have a wide moat, strong financial metrics, good forward-looking data. If you believe that for Hormel Foods, you'd be looking at an acceptable buy of up to $35 based on the estimates and judgments run through for today. If you're looking for 15%, around $33. And if you're looking what I would deem to be justifiable at 20%, around $31. Now, for those who are looking for an extra added protection at 25%, at around $29 would be your buy. Now, this is a company which does look to me, in my opinion, at oversold, and I would be looking to get in at around $29 to $30 if the price does come down that low. As we can see, the 52-week low is $30.70. But again, I can see people who are looking at a 20% margin of safety at around $31 as a reasonable price. As always though, do let me know your thoughts in the comments below. Are you looking to add Hormel Foods, looking to sell, or purely on the sidelines speculating? Wall Street are forecasting, in fact, 1 cent off our intrinsic value at $38.86, so they do also see some strong upside to the current trading price. As always, let me know your thoughts in the comments. Hit the like button if you've enjoyed today's video. Subscribe if you haven't already to join this lovely community. And as always, catch you on the next episode and take care.